changing into an uptrend according to the market flow method. Very simple. I think I touched upon it briefly just a minute ago, but real quickly. All right, market's in an uptrend, right? Real simple, right? Market moves from low to high, comes down, puts in an active low, right? Once it hits that high, it becomes an active low. High number 2 comes down to this. Active low 2 becomes an active low 2 when it matches this high. Now, for that uptrend to change from up to down, the market has to come down and break down through active low 2, the most recent active low. That's simple as that, according to the market flow method, okay? So when the market comes down and breaks active low 2, which is the most recent active low, the highest active low in the uptrend, once it penetrates down through this active low, this becomes the highest high in the uptrend. Now the trend changes from up to down. So now what you're doing is you're looking for the market to hopefully, pull back up, so you're looking to enter in there. And basically what you're essentially looking for is for the market to change directions from up to down. So the whole process begins all over again. Higher highs, higher active lows in the uptrend. Market comes down, penetrates down through this active low. Trend is now changed according to the market flow. Puts in a low, rallies up. This becomes an active high once this low is matched, minimum, with the 2 criteria that I just discussed, okay? Comes down to low number 2. This becomes active high number 2 once this low is matched with the other 2 criteria that I just discussed, meaning, at least 4 to 6 bars in this pattern, mid to upper Kiltner minimum to consider this active high, okay? So that is uptrend changing into a downtrend. Let's quickly do a downtrend changing into an uptrend. Very simple, okay? Again, the difference is, you're making lower highs and lower lows. It becomes an active high once this low is matched, right? Low number 2. This becomes active high number 2 once this low is matched or taken out to the downside. So this downtrend changes from down to up when the market rallies back up and takes out the lowest active high or the most recent active high in the downtrend. So when that happens, you're anticipating the trend to change from down to up. So this is, you're just looking for this pattern to occur, right? We're looking to buy somewhere in here. And when we get into more specifics, when we talk next about the Fibonacci retracements and how to utilize the Kiltner channel bands in conjunction with entering the market once you see the trend change from down to up or from up to down. So the same thing, if this becomes, once the active high is penetrated to the upside, this becomes your lowest low. It rallies up to this high. This will become an active low once the market comes back up and matches this high minimum. And you've got a minimum again of 4 to 6 bars in the pattern, and the market dips far enough down, i.e. mid to lower Kiltner channel band, to tell you that the market has pulled down far enough off that high to consider an active low. So that's basically it for uptrend changing into a downtrend, downtrend changing into an uptrend, okay? And then the other pattern that we're going to discuss is the trading range. All right, the last part of the market flow analysis method that I want to briefly discuss is the trading range. We've already talked about 2 of the 3 patterns that I first discussed in the intro to this section, which I said the market flow analysis method, tells you when the market's in an uptrend, downtrend, or sideways. We talked about uptrend, downtrend, how an uptrend changes into a downtrend, how a downtrend changes into an uptrend. Let's talk quickly about a sideways market. Now, really, is the market really ever truly sideways? I mean, generally, if you look back, the overall bias to the market's usually either up or down. I mean, very rarely when day trading the mini S&Ps, the market's just completely dead and sideways with absolutely no bias to the trend. So in a case like this, let's say it's in the afternoon, the market's kind of been up, but it's been sideways for the last 2 hours, let's say. I would say, okay, the market's kind of in a trading range, right, because it's a boxy, formation, but the overall trend is up. So chances are you probably entered the market there, maybe took some profits there, but let's say it's in the afternoon, it's time of day, it's a time where you'd be expecting a resumption of the uptrend. Again, we're going to talk about that later, but if the market breaks down through the trading range, I'm not automatically going to be looking to sell the market because I want to know where my moving averages are. Let's say the 79 simple and 89 moving averages are sitting there. Well, I'd probably be looking to buy it there because it's time where I'm expecting a resumption. Back to the average is probably at a fib retracement from high of the day to low of the day, but that's getting a little ahead of myself. We'll talk about that a little later. So we're talking about trading ranges. So just to let you know, if you are in a trading range, you break down through the lows of the trading range, and the overall trend of the day is up, I'm not going to be looking to sell. I still could possibly be looking to buy if the overall bias of the day trend is up. Okay. On the other hand, if the market breaks up and takes out the high of the day, that just tells me that the trend is continuing up. So by the market penetrating up to the high of the day, it just gives me another opportunity to enter the market when the market pulls back at a logical Fibonacci number. So let's just say market rallies up, comes down, I'd be looking to enter the market as long as it's not too late in the day. Okay? So other side of the spectrum again, let's say the market comes down and breaks down through the averages, you break down through the 60% retracement after breaking down through the trading range. At that point I'd be looking to sell the market on a pullback. Okay? So basically, you have to ask yourself, is the market truly in a trading range? Look at the entire day. Maybe look back at the prior day and see what the bias of the market is, and then go from there. And what we're going to talk about in a few minutes is how to use the market flow analysis method in conjunction with the 79 simple moving average and the 89 exponential moving average to give you a quick idea of what the trend is just by sitting back in your chair and looking at the overall trend. If you're trading above the moving averages and the market flow is up, trend is up, vice versa to the downside. All right. So I think that's what I want to discuss so far in the market flow analysis method. The next section we're going to talk about are Fibonacci retracements. Now we're going to discuss is Fibonacci retracements. You've already read about this in the comprehensive manual, so you should have a pretty good understanding of it already. And I briefly discussed it with the market flow because, as you know, it's part of the market flow process. Market moves up, kind of pulls down. So let's just define it as real quick. And when the market makes a move to the upside, the market pulls back somewhat, right? I mean, that pullback down off this high is considered a Fibonacci retracement. I mean, there's three levels that we're really using: the 40, 50, and 60% retracement of the last leg. So if the market moved from this low up to this high, you simply do your Fibonacci retracements, and most software charting programs already do it for you, like TradeStation or Metastock or DTN or Ensign or eSignal. All of those software programs have a built-in tool where you just drag it from low to high, click a button, and it automatically puts up your 40, 50, and 60% retracements of the last move. So it's real simple. There's no calculating to do. The computer does it for you. So basically, that's simply what a Fibonacci retracement is. Once the market makes an established move to the upside, it pulls back to some logical, area where you're expecting a bounce. So somewhere in between this 40 to 60% retracement, you're anticipating the market to bounce back up and at least test this high. Of course, it doesn't always do that. Nothing's perfect, but somewhere between the 40, 50, and 60, you're expecting some type of bounce back up. Okay, it's as simple as that. So obviously, what did we just talk about? This becomes an active low as long as the three criteria that we just discussed are met. Okay, so that's what a buy Fibonacci retracement is. So we're going to say that's an uptrend, and these are potential buy levels. And now, after I discuss sell retracements in a downtrend, which is just the opposite of this, but inverse, so let's just draw it real quick. Market moves from high down to low, right? Once the market starts to come up, you simply do your fibs from high to low, 40, 50, 60. And somewhere between the 40 and 60% retracement, you're anticipating that the market will hit some type of resistance, which is synonymous with sell. And you're anticipating some type of high to be put in place, in which we call an active high, as long as this low is retested and the two other criteria that we just discussed in the market flow are met. Simple as that. It becomes an active high. But only once this low is tested, okay? So somewhere between the 40 and 60% retracement of the last move from high to low, and again, we've already defined the market flow analysis method. So we've defined trend. We're going to take it a step further in the next section and go a little further defining trend. We've already defined trend in the market flow, but next we're going to add the 79 simple and 89 exponential in conjunction with the market flow. But this is simple. This is as simple as it gets. That's the Fibonacci retracement. Okay, market doesn't go straight up without pulling back somewhat. And when it pulls back, the levels that it pulls back to are generally pretty predictable areas that the market bounces or reacts down off of. All right? All right, what we're going to talk about now is a concept by the name of Fibonacci confluence. You've already read this in the comprehensive manual. Very easy to understand. Let's define it real quick for you. It is when you measure two Fibonacci swings in the same trend direction and then compare the two Fibonacci sets of numbers to one another to see which one is closest to one another. So let me draw a diagram quick for you and show you what I mean by that. Alright, so the market's got a low, the lowest low, comes up to high number 1, drops down. This is, remember, again, this becomes an active low only once this high is matched or taken out and the other two criteria are met the way I defined it earlier. Goes up to high number 2. Now it's coming down off of high number 2. Now you've got the ability to draw on your Fibonacci confluence. So what you're going to do is you're going to always measure the biggest swing and then the smallest swing in that trend. The trend is up, so the biggest swing would be taken from high number 2 down to the low in drawing those fibs, 40, 50, and 60% retracement. Again, since it's an uptrend, these are potential buy retracements. So from high number 2 to low, let's just say this is the 40% retracement, 50% retracement, 60% retracement of that up move. Then what we're going to do is measure from active low number 1 to high number 2 and draw in those Fibonacci retracements. Now I'm not a good artist here, so this active low should have probably been a little higher to give you a little bit more. But let's just say from active low high to 2, these are smaller numbers. Let's just say the fibs of those numbers are here, here, and here. Okay? So that's the 40, 50, and 60% retracement. Alright? So the two that are closest, we'll just say the 50 of the smaller move and the 40 of the bigger move are like right on each other. That'd be considered Fibonacci confluence. But the most common confluence numbers would be the 40% retracement of the biggest move from high 2 to low, and I would say the 60% retracement of the small move from active low to high number 2. Those are the most common Fibonacci numbers that you're going to see when you're doing this live. Alright? So, you know, of course, if the market's pulling back and you got a third pullback, the market comes down, maybe rallies up again and comes down, and it's the third pullback and this becomes active low number 2, the market's coming down off the third high. If you were looking to enter the market, the way you would do this, you would draw from the new high, the highest high number 3 rather, to low, right, those big numbers. So you'd be measuring from high 3 to active low, alright? So high 3 to low, do the fibs of the big numbers, let's say that's 40, 50, and 60, and then you would measure from your active low, so this would be active low number 2 since that's active low number 1, active low number 2 to high 2, draw and measure this swing. So on your computer software program, just put in your cursor, move it from low to high, click your button, and it'll print out your, put your numbers on your screen for you, 40, 50, and let's say that's 60. Look at those two trend swings from the biggest high 3 to low, and active low 2 to high 3. So these are the small set, the big set. Take a look at those two sets and see which numbers are closest to one another. In this case, the 60 and 40 are really close to one another. Now let me just tell you that they don't need to be sitting right on each other. Let's just say the 60 and the 40% were, a point or 2 or 3 points apart. That's fine. I still consider that zone a confluence zone. So all I do is I put my cursor right in between the two. So if there's a big gap between the two that are closest to one another, I put my cursor right in between, and that's where I'm looking to buy the market on a bounce. That's as simple as that. That's all confluence is. So if you understand the market flow analysis method properly, you'll know exactly where to measure the fibs from. So without understanding the market flow and the significant highs and the significant active lows in an uptrend or significant active highs in a downtrend, then it'd be more difficult for you to understand where to measure to calculate these fibs. So since you understand the market flow method, this should make it a lot easier to understand. Alright, now what I'd like to address is the 3 most commonly asked Fibonacci retracement questions regarding the fibs, okay? The first question I always get asked is, how do you know which Fibonacci retracement to enter the market? I mean, after all, there's 3 different fib levels to look to enter, either the 40, 50, or 60. How do you know which one to actually look to get in on? And actually, that all depends on the pullback. First of all, if you're in an uptrend and the market's coming back the very first time, okay, first of all, we're going to address this in just a few minutes, but that question you've got to ask yourself, first of all, is this the first pullback in the trend, second pullback, third pullback, fourth pullback? And there's an answer to each one of those, okay? So it really depends on which pullback in the trend you're in. So again, the question was, How do you know? 40, 50, or 60? I mean, when the market's coming down off of a high, I mean, you got three levels. What do you enter here, here, and here? Or, I mean, which one do you enter? So we're going to address that in just a bit. So you got to ask yourself, is it the first, second, or third pullback? Second question is, how do I prevent from missing a trade? Because after all, if you're placing an order at the, let's say, the 40% retracement to go long the market, anticipating to bounce back up to retest that high minimum, what if the market comes down and it's not able to quite get there and it bounces back, it starts to bounce up? I mean, how do you prevent from missing a trade? So, because remember, you are looking to enter at a particular level. If you choose the 40% and the market doesn't quite come down that far and it misses you, I mean, how do the answer to that is there is no way to prevent from missing a trade. I mean, if you put in your order right at the 40% retracement to go long and it does not get there, you missed it. Plain and simple. Now, you don't want to get into the habit of, oh man, the market's real close to my entry and it doesn't look like it's getting there, so you just get it. I mean, you don't want to get whipsawed. You don't want to be chasing the market every time you think that you missed a trade. That's not the way to go about it. You got to be patient and disciplined. You got to wait for the market to come back to you. That's when you enter the market. So again, there's no way to prevent from missing a trade. Another scenario would be, well, let's say if I wanted to get it to 50% and the market came down and didn't quite get there and it bounced it to 40%. Again, you missed it. You had your order into 50, didn't quite pull back that far, started to rally up, you missed it. You do not want to get into the habit of chasing the market. Okay, another question I get, and now think about this real carefully here. You should be able to answer it yourself. People ask me all the time, well, how do you know if the market's retracing versus the market completely reversing trend? I mean, let's think, the market's coming down off the high, right? When it's coming down off the high, you're picking a level. You've defined trend. The trend is up. You're looking for a bounce somewhere between the 40 and the 60% retracement, right? So let's just assume you pick the, you want to get it to 50%, let's say, because you think that's, according to my rules, it's 50. Okay, we'll assume it. So you're always asking, as it's coming down, you're thinking, damn, how do I know if it's going to bounce at this level or if it's going to continue going lower and reverse the trend 100%? I mean, let me give you the answer. The answer is quite simple. I mean, I don't know that. If I knew that, I'd never be wrong. I'd never be wrong, and that's the age-old question in trading. How do you know if it's retracing as opposed to completely reversing the trend? You do not know that. If you knew that, you'd never be wrong. You'd be the richest guy in the world. So there's no way to know that. All I know is based on what I teach. I mean, remember, trading is a probability game, and you're trying to stack the probabilities in your favor. And what I'm teaching you, the probabilities do favor you, when applying this correctly. So, again, how do you know if it's going to bounce as opposed to just coming all the way down and reversing the trend 100%? So the trend was up, market comes down, you're looking to buy the market here, maybe you get a little bounce, but then the market collapses. Okay, I mean, occasionally that'll happen, but again, later when I discuss trade management and how to work a trade, stick your stops, take profit objectives, that's going to make everything come together and show you exactly how to work a trade and trade the right way. But again, the answer to this question is you don't know with 100% certainty if the market is in fact going to bounce somewhere between here or come down 100%, therefore reversing the trend 100%. Again, if you knew the answer to that, you'd never be wrong, and obviously that's impossible. Now is not in the comprehensive manual. It is kind of like a cheat sheet in terms of how to enter the overall trend. I stick overall in there. We've already talked about the market flow analysis method based on, trend based on the market flow analysis method. And the market is trading above the 79 simple and 89 exponential moving average. That's your overall trend. So there's two criteria to define an uptrend. The market flow is up, according to what you've already learned, and the market is trading above the 79 simple and 89 exponential moving average. Added the mid-Kiltner crossed up through both of the moving averages. The reverse scenario would be a downtrend. Market's making lower lows and lower active highs according to the market flow analysis method. And the mid-Kiltner has crossed down through both the 89 and 79 simple moving average. When that occurs, the trend is down. So let me just draw you just a real quick diagram. I mean, real simple here. So let's do an uptrend. That's the 79 simple, and that's the 89 exponential. Market was coming down. We'll just say this is an active high here. in the market flow. Now the market rallies up. Not only does the market take out the most recent active high in a downtrend, okay, so the market has taken the most recent active high in a downtrend to the upside. That changes it according to the market flow. And then you also notice that the mid-Kiltner, which by the way is an 8-bar exponential moving average, crosses up through both the 79 simple moving average and 89 exponential moving average. Okay, the overall trend is now up. Okay, so now we've defined an uptrend. Downtrend, so quick illustration here. You know, so in a downtrend, just the reverse. Let's say you were up, now the market's dropping. Okay, so we'll just assume that this is the most recent active low, right? In an uptrend rather. Market takes out the most recent active low to the downside, and the market starts to penetrate down through both of the moving averages, the 79 and the 89, and the mid-Kiltner crosses down through both. And again, you'll read this in the comprehensive manual, the downside mid-Kiltner penetrations and the upside mid-Kiltner penetrations. So when you get a downside mid-Kiltner penetration, again, which is an 8-bar exponential moving average, moves down through both of the moving averages, and then the market flow shifts from up to down, now you're in an overall downtrend. So when I talk about how to enter the overall trend, that's what I'm talking about. The market flow analysis method and the mid-Kiltner penetration. So you need the mid-Kiltner to cross through both the 79 simple and 89 exponential moving average. Or in an uptrend, the mid-Kiltner needs to penetrate up through both, not one, but both. So the 79 to 89 moving average means absolutely nothing until the mid-Kiltner crosses through both and the market flow switches directions. Okay? So let's answer some questions here, and that's really important. First thing is, you've got to, the questions I get is, how do you enter the market? How do you specifically enter the market with all the knowledge and everything that you're learning in these videos and DVDs and my entire course? How do you enter the market? You've got to ask yourself a few questions. Is the market an uptrend or a downtrend? You've got to define that for yourself. Once you've defined it, you've got to ask yourself, is the market pulling back the first time? Second? Is it the first pullback in this trend? Is it the second pullback? Is it the third? Because there's an answer to each one of those. Okay? All right.